Today we will present our report on inventory valuation and financial reporting analysis under MFRS 102 for Brightmart Trading Sdn Bhd. Inventory refers to goods purchased and held for resale in the normal course of business. It is one of the most important current assets for a trading company because it directly affects profit, cash flow, and financial position. MFRS 102 provides the accounting standard that govern how inventory should be measured, valued, and reported in financial statement. The main objective is to ensure that inventory is not overstated and is for record at realistic value. For the initial measurement of inventory, all costs directly involve the bringing the inventory to its present location and condition are included. In this case, the purchase price is 1,020 ringgit, import duty is 6,000 ringgit, and freight inward is 4,500. These are directly attribute costs and must be capitalized into inventory. However, the trade discount of 3,000 is deducted because it reduces the actual purchase cost. On the other hand, administration expenses of 2,000 are excluded as they are not directly related to the acquisition of inventory.
After initial recognition, inventory must be measured at the lower of cost and net realizable value or NRV. According to MFRS 102, this ensures that inventory is not overstated in financial statements. Net realizable value refers to the estimated selling price of inventory in the ordinary course of business, less any estimated cost of completion and selling expenses. For product A, the cost was 20,000 while the NRV was 80,000. Since the NRV is lower than the cost, the inventory must be written down to 80,000, resulting in a write-down of 2,000. For product B, the cost was 50,000 and the NRV was 70,000. Since cost is lower than NRV, no write-down is required and the inventory remains at 50,000. For product C, the cost was 10,000 while the NRV was 7,000. Therefore, a write-down of 3,000 is required. In total, the inventory write-down amounts to 5,000. The carrying amount of total inventory after adjustment is 40,000. These write-downs occur due to a change in market condition. Product A experienced a drop in selling price while product C became obsolete due to technological advancement and reduced demand.
When inventory is sold during the accounting period, it is no longer as an asset. It is recognized as an expenses, now as cost of sales. Cost of sale represents the direct cost of goods sold during the period and is matched against revenue, determine gross profit. For Brightmart Trading Sdn Bhd, the cost of sale recognized during the year is 95,000. In addition to this, the inventory write-down of 5,000 ringgit must also be recognized as an expenses in profit or loss statement. This ensures that loss its value are properly reflected in financial reporting. Therefore, the total inventory related expenses recognized for the year is 100,000 ringgit. This treatment follows the prudence concept, which ensures that profit are overstated properly, loss are recognized when they occur. By applying this principle, the financial statement become more reliable and relevant for decision making by users such as investor management.
According to MFRS 102, companies are required to disclose specific information related to inventories in their financial statements to ensure transparency and full compliance. The required disclosures include the accounting policy adopted for inventory valuation, the total carrying amount of inventory, the amount of any write-downs recognized during the period, and the cost of sales recognized in profit or loss. This disclosure help user of financial statements understand how inventory figures are derived, and whether any significant adjustment have been made during the year. Proper disclosure also improves comparability between companies and ensure compliance with accounting standards.
To improve inventory management, Brightmart Trading Sdn Bhd should implement several strategies. Firstly, the company should regularly monitor inventory levels to avoid overstocking or understocking. Secondly, market prices should be reviewed frequently to ensure inventories is not overused. Thirdly, Maintaining accurate and updated inventory record is essential for effective control. In addition, yearly stock count should be conducted to verify physical stock against recorded amount. Finally, the company should take proactive steps to reduce obsolete or slow-moving inventories to minimize potential losses. In conclusion, Brightmart Trading Sdn Berhad has complied with MFRS 102 in valuing its inventory. The initial inventory cost was 137,500 ringgit. The year-end carry amount was 40,000 ringgit, and the total inventory related expense recognized was 100,000 ringgit. Proper application of inventory valuation standard ensure accurate financial reporting, improve transparency, and support better business decision making. Thank you.